turned out to be the case yet, or is it still too early to know? And is the banking community happy with the direction that the current administration is going, or you just don't know yet?
If you think about the great financial crisis and Dodd-Frank and a lot of capital rules and liquidity rules and all that stuff came in, there was a reason for the world writ large to be really not happy with banks and non-banks that became banks, Goldman Sachs, Morgan Stanley, Merrill, et cetera. So you could understand that. When you go fast forward through the 15 years hence, plus you go through the pandemic and the banking system stands up and stabilizes the economy. You go through the regional banking crisis, the banking system steps up and stabilizes it, and they keep adding capital and liquidity. You're sort of saying, wait a second, we are a source of strength. And by the way, the American banking industry is really a source of strength. So the pendulum kept just swinging, even though the reason why it had swung had stopped. And so our industry would say, wait a second, why are we have 20% more capital than we did during the pandemic? The risk is the same. It's just by mathematical creep of calculations.
So many people, when they talk about the Federal Reserve, they wonder whether the Fed's going to increase interest rates or decrease interest rates. But in the banking community, you're often worried about the stress tests.
Right.
And do you think the Fed has pushed stress tests to too tough a limit on banks, or are you okay with the current stress tests?
So the stress tests are publicly available. I think the first one was 2010 and then picked up in earnest 11 or 12. And so every year you can see this report card on the banking industry's health. And every year the banking industry has great health. The rules kept changing the tests. So if you think of the last 4 or 5 years, you had volatility and capital requirements that were, went from 50, 75 basis points up and down a year with basically a test that said 10% unemployment, 50% downturn in the equity markets, 30% drop in housing, 30 or 40% drop in commercial real estate, high yield spreads blown out by 1,000, 2,000 basis points, whatever it was. You look at all that, the same test produces different results. It didn't make sense. So behind the scenes, the transparency wasn't there, and that's what we end up suing them on. So the stress tests are a very good thing. Frankly, it gives us state of health for 31 banks, which cover most of the industry. The way the United States run was far superior. We do stress tests every quarter, multiple scenarios, and our trading book is stressed every day. So if you think about it, it's a good thing. It's just that behind the scenes, what was happening is that dials were being turned on us, and the numbers were becoming irrational to the market. And we have investors, and we have to raise capital and have capital available for the industry.
So there's a vice chairman of the Federal Reserve who's in charge of regulating banks and so forth. That person has given up that position recently. And was that something the banking community was happy with, that he stepped aside, or you didn't really care whether he stepped aside or not?
Well, at the end of the day, I think he had a year left on his term, and the new administration president would appoint someone for that position. Look, at the end of the day, as when people always ask me, do you have different approaches for different administrations? And you say, well, in the long term, we've been around since Washington was president. So if we geared ourselves up for this president, not that president, we'd have to change 45 times, or whatever it is. And if you think even in the foreign soil, think how many different prime ministers there's been in England, or so even in my tenure as CEO. So at the end of the day, you run the company the right way. And what we're trying to say is get us to a rational regulatory structure and have it stick to the ribs. If you keep swinging like this, our clients can't depend on us when they need us.
So recently, another banker you probably heard of, Jamie Dimon, and he testified on Capitol Hill that maybe the regulators and Congress should get together and say, let's just start afresh and take a look at all the banking regulations from a fresh perspective, building from scratch. Do you have a comment on that? Is that a good idea? Or
just take the Consumer Bureau. In 2010, with Dodd-Frank, 10 or 11, they set up the Consumer Bureau. The theory was that all the consumer regulatory activity would move to a new agency. Guess what? We still have the OCC regulates consumer activity, still have the Fed regulates consumer activity, still have the FTC will hit consumer activity on occasion, and you have the Consumer Bureau, and if you have the FDIC as a regulator, you have the FDIC.
You're regulated by the Federal Reserve, the FDIC, the Comptroller of the Currency. So do you spend a lot of time with the regulators, or you try to avoid that?
I'd like to spend time when they're telling us we're doing good stuff. We all spend a lot of time, and I have a great chief risk officer, Jeff Greener, who organized that for the company. All my senior executives spend time with them. And look, the day-to-day regulators are trying to help us be better, and we understand that. We are on the road to perfection as a company. And as Vince Lombardi said, you strive for perfection, excellence to be found. That's what we're trying to do. If they've got ideas, we're all ears. Simplifying the organization will allow frankly, cost to be taken out from the regulatory side, and we pay fees to support it. And it wouldn't be the worst idea.
Now, when interest rates go up, the theory is that banks can charge more for loans, and therefore they're more profitable. And banks have been very profitable in recent years. When interest rates go down, is that a concern to banks because you have less profitability, or you really don't care?
Well, the toughest time to be a bank with $1 trillion, $2 trillion of deposits is when interest rates are zero, because we can't charge people to store their money. We're not like a self-storage unit or something like that. So at the end of the day, you have a floor on interest rates. And so when interest rates came down, you started squeezing margins. So the loan rates came down, but the deposit rates have a zero floor. When rates move up, that changes. And so the zero interest checking accounts, all that stuff become worth more, and loan rates go up.
Because interest rates come down, though, it's not going to affect your profitability?
Not a lot, because you have...
right? So you don't want Jay Powell's job, it sounds like, but suppose he called you and said, should I increase interest rates, decrease interest rates, or hold them the same? What would your advice be?
Our team right now is basically says there'll be no further rate cuts through their forecast period, which is this year and next year. Inflation is coming down, but is a bigger fight. And in the end of the day, there's the dual mandate, employment, inflation. Employment, they're in great shape on. Inflation, it's been coming down, it's working its way down. It takes multiple years to squeeze inflation out. And there's a drag on the economy today. And so you're seeing economic growth from 3% in the last couple of quarters to 2%. We have it moving down to 2%. Our expectation is they won't cut rates.
So let me ask you, the business that my firm has been in is private equity, but now private equity firms have become private credit firms as well. And private credit firms, they lend money, but they're not regulated quite the way you are.
Right.
So is that a source of concern that we can lend money and we're not as highly regulated as you are, and you're lending money, but you're highly regulated?
I think I care about your firm, but look, at the end of the day, the private capital has grown because they can do something we can't along a couple dimensions. One is they can finance companies that may have more leverage, and we are basically stopped out at 6 times leverage, and that used to be a rule, then it was taken back, then it was guidance, and then it was like, wait till we examine you. So and we do go above it for certain credits and stuff like that. So that's one thing. The second thing is the ability to bring the whole capital structure, debt, equity,
right,
the whole, mezzanine, the whole 9 yards. That's hard for a bank because we don't engage in equity business. But on top of that, we have $1 trillion of commercial loan commitments, $500 million plus of drawn loans. We don't fear any competitor, and we work with those companies, including yours, to generate assets for them. But it's just a different style. I think the world should be concerned to make sure that those enterprises making loans to $1 billion operating company have the ability to work with them in times of stress. That's going to be an interesting question. We haven't gone through a stress period with this practice out there.